Each of the following items is included when computing the firm's target cash conversion cycle, except, now let me show you how do we calculate cash conversion cycle. Cash conversion cycle is equal to days in inventory plus days in account receivables. Sales is in account receivables. Or in other words, the inventory turnover in days, account receivable turnovers in days, minus the accounts payable turnover in days, or sometimes called the days in payables outstanding. So, which of these is not required? We need days in inventory. We need days of payable outstanding. We need days in account receivables or days sales in account receivable. We need ABC, but not cash discount. No, there is no such thing, cash discount period. That is the right option. The cash conversion cycle of an organization would improve under which of the combination of performance results shown below. Cash conversion cycle is equal to days in inventory plus days sales in account receivables minus days of payable outstanding. So if you want to have as short a cash conversion cycle as possible, so days in inventory must be as low as possible. You should hold your inventory as little as possible. You should collect your money from your customers as quickly as possible, and you should delay to your suppliers as long as possible. So reduction in days in inventory, reduction in days sales in inventory, and increase in the days of payable outstanding will lower your cash conversion cycle. And if you match, this is the perfect match, B. Which of the following ratio is appropriate for evaluation of account receivables? In the reverse order, current ratio, it is appropriate for evaluation of liquidity. Collection to debt ratio has nothing to do with the evaluation of account receivables. Return on assets, this is an appropriate for the evaluation of profitability, return on the total assets, but not on the evaluation of account receivables. That is it. Day sales outstanding, how long your customers take to pay you, or how many days your days sales remains outstanding in the form of account receivable, that is the right option, A. An increase in sales collection resulting from an increase in cash discounts for prompt payment would be expected to do what? Sales collections are increasing, so that would decrease your operating cycle. That would decrease your average collection period. Customers will pay you more frequently, right? Decrease in the cash conversion cycle, this is right. When your customers pay you more promptly, your operating cycle reduces, your average collection period falls. In other words, the cash conversion cycle falls. Increase in bad debt losses would decrease from an increase in sales collection, because when you collect your money more frequently, so the chances of bad debts will decrease. There will be less bad debts, so this is wrong. Decrease in bad debts, hence the wrong option. The following table contains Emerald's quarterly revenues in thousands for the past 3 years. During that time, there were no major changes to Emerald's selling strategies and total capital investment. In year 1, 500 in quarter 1, quarter 2, quarter 3, quarter 4. Year 2, quarter 1, quarter 2, quarter 3, quarter 4. Year 3. See, there is always an increase in quarter 3 and quarter 4 from the previous numbers in each year. So more or less, this is because of seasonality. The fluctuation is caused from seasonal demand of Emerald's products, and Emerald should manage its inventories and cash flows to match the cycle. Seasonality, the numbers changing because of different season and different quarters, that makes D to be the correct option. Now, why did I reject A, B, C, D? Economy has nothing to do with economy. Quarterly results are showing out a consistent pattern in all these 3 years, so this is nothing to do with the economy. Then why not C? Fluctuations are from the seasonal demand for Emerald's products. To this extent, it's fine. Emerald should examine its cost structure for potential changes. There is no issue for cost here. The issue is to manage the inventories and cash flows. This is the reason we rejected C. A company has cash of 100 million, account receivable 600 million, current assets 1.2 billion, accounts payable 400 million, current liabilities 900 million. What is the quick ratio? We know quick ratio is equal to cash, marketable securities and account receivables divided by current liability. So what is in the numerator? Cash, account receivables, no marketable securities are given. And what about the denominator? We have already been given the current liabilities, just use this number and that's all. So cash 100 million, account receivable 600 million, current liabilities 900 million. If you simplify this, 0.78. B. How would the following ratios or measures be affected if the company issued additional capital stock for cash? When additional capital stock was issued for cash, that means cash balance goes up, which means your current assets go up, which means your total assets go up, right? Total debt to total assets, total debt to total assets. Since your total assets are going up, the denominator is increasing, that will cause the ratio to fall. Working capital, since your current assets are increasing, and we know working capital is equal to current assets minus current liability. So when current assets go up, working capital goes up. So it's going to be decrease, increase, that is C. Bell Company changed from traditional manufacturing philosophy to just-in-time philosophy. What are the expected effects of this change on Bell's inventory turnover and inventory as a percentage of total assets? If the company moves from traditional to just-in-time, in that case the inventory balance will fall. If the inventory balance will fall, then you will have to purchase your inventory more frequently, so inventory turnover would increase. And since inventory will fall, so the new inventory balance, which will be very little, will be a very less percentage of your total assets. Inventory as a percentage of total assets is going to decrease under just-in-time, so it's going to be increase, decrease. That makes C to be the correct option. A company targets gross margin is 40 of the selling price, margin is percentage of sales, and the cost of the item is 178. The unit selling price should be, there is a quick way of doing it, write CSP. C stands for cost, S for selling price, P for profit. So it says your margin is expected to be 40, which is based upon sales. Then sale has to be 100. If profit is 40, based on sales, sales must be 100. And if sale is 100, profit is 40, the cost must be 60. This is a very fantastic way of doing any question involving CSP, cost, profit, and sales. So if the cost is 178, you can directly find the selling price or profit, whatever is required. Since we need to find the selling price, market X, make a cross and solve it. 60 times X is equal to 178 times 100, and you will get X is equal to 178 times 100 upon 60, and if simplified, it will give you 296.66, so on. That makes B to be the correct option. Let's say if the question required you to calculate the profit, you can call it Y, and in that case, this would have been the arrangement. Y times 60 is equal to 178 times 40, and if you simplify, it will give you 118.66. That is your profit. Now let us just cross check. If this is the profit and if this is the cost, this plus this should be equal to the selling price. Is it? Let's see. 178 plus 118.66. Perfect. 296.66. This will be very helpful, so please note it down. Which of the following transactions does not change the current ratio or the total current assets? A cash advance is made to a divisional officer. In this case, cash balance falls. Cash balance fall means your account receivable, the other divisional office will represent an account receivable. AR goes up. So just cash decreases, account receivable increases. That means the total current assets, they stay the same. That is why total current assets and current ratio, they are not affected. And that's why A is the right option. Now, why not B? A cash dividend is declared. When cash dividend is declared, the cash falls. Resultantly, your current assets will fall. So your current ratio will fall and the total current assets will fall. Short-term notes payable are retired with cash. So if short-term notes payable are retired with cash, that means your cash falls, your current assets fall, your current ratio will fall, your total current assets will fall. We are looking for the one that doesn't change the current ratio or the total current assets. Yes, it will decrease your current liability, but that is not being asked. Equipment is purchased with 3 years note and a 10% cash down payment. In this part only, cash falls, current assets falls, current ratio falls, total current assets falls. So none of A, B, C, D is helping us get the right option. A is the one. A corporation manages inventory performance by monitoring its inventory turnover. Selected financial records for the corporations are as follows. Annual sales are given for 3 years and gross annual profit percentage is given for 3 years. the beginning finished goods inventory for year 2. What are we required to find? What was the corporation inventory turnover for year 2? So we are interested for this year. It says the opening stock for year 2 is 20% of the sales in year 2. So opening stock is 20% of 106 to 500. This. And if you simplify, it's going to be 212,500. This is your opening stock. And it further says the ending finished goods inventory for year 2 is 18% of year 3 sales. This is year 3 sales. And if you take 18% of this number, you will get 262,620. This is the figure for the closing stock. Now what we need cost of goods sold, because remember, inventory turnover is equal to CGS divided by average inventory, right? How do you find CGS? It's pretty straightforward. 30% is your gross profit of this number. 30% of this number is gross profit. Then that means 70% of this number of sales would be your cost of goods sold. So 70% of your sales is your cost of goods sold, which will be 743,750. The next step is to calculate the average inventory. Add 212,500 in 262,620 divided with 2, or I just simply write it down in the denominator. Average inventory is equal to opening stock 212,500 plus closing stock 262,620 and divided with 2. So this is in the denominator is the average inventory. CGS in the numerator. If you simplify, you will get 3.13, and that perfectly matches with your option D. A corporation has $50,000 in equity and a total debt ratio of 0.5. The firm wants to reduce this ratio to 0.2 by selling new common stock and using the proceeds to repay principal on outstanding long-term debt. What amount of additional equity financing must the corporation obtain to accomplish this objective? A fantastic question. Your starting point would be the debt ratio. Right now, our debt ratio, that is debt to assets, is equal to 0.5. We can write this as debt. We know assets is equal to liabilities plus equity, so we can write it as debt plus equity. Accounting equation, asset is equal to liabilities plus equity is equal to 0.5. Now we have been given equity as $50,000, so we can replace equity with $50,000. This will give us the debt 0.5. If you make D the subject of the equation, it is going to be D is equal to 0.5 times D plus 50,000. Then it's going to be D is equal to 0.5 D plus 25,000. And if you make the D subject, it should finally give you $50,000. So your debt is, interestingly, $50,000. Now what we want our new debt ratio, debt upon assets, to be 0.2, right? We know assets can be replaced with debt and equity. We want the result to be 0.2. Right now our debt is 50. What should be the level of equity so as to bring the ratio down from 0.5 to 0.2? If you make equity the subject of this equation, equity has to go up to a simplification will give you $80,000. The same simplification we did here. First we made D the subject, here we'll make E the equity the subject. Now the question says, what amount of an additional equity financing must the corporation obtain to accomplish this objective? We need to raise our equity up to 80. Right now our equity is 50, so it must increase by $30,000, and that makes B to be the correct option. The CFO of a company is concerned about the company's accounts receivables turnover ratio. The company is currently offering customers term 310 net 30. If the discount is to be availed, payment must be made within 10 days. In that case, 3% discount would be offered. Otherwise, net payment is due on 30th day. Which of the following strategies would most likely improve the company's account receivable turnover? Pledging the account receivables to a finance company. Pledging won't help. You're just pledging your account receivable. It would neither impact sales or account receivables, so this is not recommended. Changing customer terms to 110 net 30 from 310 net 30. If we reduce the discount percentage from 3 to 1%, it will not incentivize customers to pay quickly. Rather, it will reduce incentive to pay. Customers will take more time, so your account receivable turnover will fall. This is not good. What about C? Entering into a factoring agreements with the finance company. This way, a firm will sell its account receivable will fall, and when the account receivable will fall, your account receivable turnover would improve. That is the right option. Changing customer terms to 320 net 30. Now again, if you increase the discount days, if the payment is made within 20 days, then 3% off. In this case, the customers will delay. It will reduce the incentive to pay quickly, so this is again not recommended. C is the right option. Faro company is applying for a loan in which the bank requires a quick ratio of at least 1. Faro quick ratio right now is 0.8, less than 1. Which of the following actions would increase Faro's quick ratio? Purchasing inventory through the issuance of long-term note. Quick ratio has nothing to do with inventory, because inventory becomes a part of your current assets as the part of current ratio, not a quick ratio. This is wrong. It won't affect this ratio. B. Implementing stronger procedures to collect account receivables at faster rate. If account receivables are collected at faster rate, so that means your cash balance goes up, AR falls, but overall the current assets remain the same. So there is no net impact on current or quick assets, so it won't help as well. Paying an existing accounts payable. Now this is a very interesting, it requires discussion. Right now your quick ratio is 0.8, which is less than 1. Whenever the case is this, that your ratio is less than 1, if any transaction results in change in the numerator denominator, I would like to discuss this idea. This is a very helpful concept here. If the quick ratio is less than 1, like A upon B is less than 1, if a transaction is entered into which causes a reduction in the numerator and denominator by the same amount, the ratio will deteriorate. Now let us say, right now 80,000 is our quick assets and 100,000 is for our current liabilities. So the ratio is 0.8, which is clearly less than 1. Now if you decide to pay to our existing accounts payable, let's say our accounts payable is 50,000. So that means 50,000 will be removed from numerator, from cash, and 50,000 will be removed from denominator as a reduction in accounts payable. So the new number will be 80 less 50, 30, right? And 100 less 50 will give you 50,000 as a new denominator. So see what happens here. 0.6. So your quick ratio has fallen. So this is not going to work. Faro quick's ratio is 0.8. Which of the following actions would increase? This action would decrease the quick ratio. Not the right thing to do. Selling obsolete inventory at a loss. Even at a loss, selling an inventory will increase your cash balance. And this cash balance feeds into the quick assets. Quick assets goes up, so your quick ratio will improve, right? Why inventory will have no effect? Because quick assets do not include inventory. So when you sell inventory, there is no impact of inventory on the quick assets, but the resulting receipt of cash will increase your quick assets. Hence, the quick ratio will improve. So that makes D to be the correct option. Okay, Jackson Distributors sells to retail stores on credit terms 210 net 30, discount of 2% if payment is made within 10 days, else full payment on 30th day. Daily sales average 150 units at a price of 300 each, assuming that all sales are on credit and 60% of the customers take the discount and pay within 10 days, while the rest of the customers pay on 30th, 40% pay on the 30th day. The amount Jackson's account receivable is. Okay. Now look at this. Our selling price is 300. Our daily unit sale is 150, out of which 90% is for the customers who pay within the first 10 days, 60% of them, and remaining 150 is 40%, that is 60 units. They are sold on daily basis to those customers who pay us after the discount period. So our daily sales to those customers who pay us in the discount period is $27,000, and to those who pay us on after the discount period is $18,000, right? This sales $27,000 remains outstanding for 10 days, $270, and $18,000 sales to those customers who pay us after the discount period. They pay us on 30th day. So this amount remains outstanding for 30 days. So what you get is 540. Adding these two up will give you the average account receivable. So this was the method given in the suggested solution. You can find another way to do it in a quicker way. You sell $300 per item and you sell 150 items each day, right? So which means your daily sales is 300 multiplied by 150. That is $45,000, right? $45,000 is what you sell on every day. Out of this, 60% is to the customers who pay us within 10 days and remaining 40% pay us on at the end of the 30th day, right? So, and how many days are there? 10. And how many days are there? In this case, 30. So if you just simply multiply 45,000 multiplied by 60% times 10, that gives you 270. And again 45,000 multiplied by 40% times 30, 540. So it ends up again at 810. That's C.